All right, so today we are just freestyling and I'll be using the 4 hour. This is USD JPY and you can clearly see where I'm starting. That is January 2025. Yeah, so clearly we can see this one here. Let me just write here. This is the inducement is taken out, then price broke past that swing point. Again, inducement taken out, price breaking past that. Then after that, price breaks past this low, meaning now we are no longer bullish, but we have now shifted bias to, bearish. So we can clearly see price did that, and then price created a valid pullback. After that, you can clearly see this pullback because yeah, this one here is not a valid pullback. You can clearly see this is an insider bar, and the valid pullback here was this one, and price has yet taken that. So price created another one, so meaning in this range, which starts from this high all the way to this low, there is no any taken, like there is no any taking out of some high or buy side liquidity, meaning that there is no confirmation of any swing point low, because we said we confirm a swing point low in this bearish scenario once the inducement is taken out. So this means this is just a random valid pullback, and since it is the recently formed, then the high is what we call the inducement. Right, so exactly right here, this one here is what we call the inducement, and right now I'll be waiting for price to take that out before I can confirm the break of structure, or I can confirm like this one here to be a swing point. All right, so let me run price. All right, so let me make it fast. Exactly right there, you can see price has taken out the major inducement. In this case, of course, it's a major inducement. And now we all know that's the right moment to mark now the POIs. So we have identified our trading range starting from this high all the way to this low, and this is a bearish trading range. So meaning we'll be only looking for the bearish POIs, that is the bearish order flows, of which is the one that we are supposed to start with, because the order flows are primary and the order blocks are secondary. So starting from the range high, we always start from the extreme of the trading range. I can clearly see that there is this, right, so pullback and then pullback. So all of this is what we call the, all right, so yeah, from here, then it's already mitigated. You can clearly see that this pullback, that you can see price broke past the order flow and then reversed back, retraced back and mitigated the order flow. We said valid mitigation is by a valid pullback, and we can clearly see that that is a valid pullback. Again, the order flow, of course, is from here. If you want to refine it, that's when now you will make it there. But I said it's always advised to just mark the whole order flow, not refine it. Not unless, like, you are refining it, but the order flow, actually the actual order flow, is not the refined one, it's actually the whole buying move. So in this case, this is the move, and we said that a valid mitigation is by a valid pullback, and we can clearly see that this is just a bullish candle, and that candle is not, like, does not, the scenario does not meet a valid pullback. So this means our order flow is not mitigated, and this is the extreme order flow, because the extreme one, we can clearly see it's already mitigated, and we said the ones that are unmitigated are the ones that we are actually interested at. So right here, since this one here is not a sweep, because if it was a sweep, then I would, like, it wouldn't, like, price wouldn't have formed this small displacement. Price wouldn't have formed like this. This is a quite a big displacement from the major inducement. At least price would have displaced a little, or price just wicks above that and rejects in. But in this case, you can see price displaced with a significant body size. So in this case, this is not a valid sweep, and I'll be waiting for price to mitigate this. Yeah, of course, mitigate this order flow before I take the reversal, and of course I'll be targeting this swing low, or in that case it's what we call the external liquidity. All right, so let me run price and see what price does. And by the way, of course, after price mitigates the key area, we said the only thing that will make us get into the trade is not its mitigation, it's what price does from our once price has mitigated the area. We need to see price rejecting with a good reversal sign, a good reversal pattern, and I covered the reversal pattern, of course, on the previous class. We all know the reversal patterns that we covered: the long wick rejection, the multiple wicks, the bullish engulfing, bearish engulfing, morning star, evening star, the shrinking candles, and the momentum candles. I want to believe that you all have mastered the names, even though it's not a must, but it's always good and advisable. So right, so let's see. All right, price is rejecting without mitigating the zone. So this means in our case, this one here will be a missed trade. Anyway, price has yet made it out to the external liquidity. So let's see. All right, so all right, price has made it out to the external liquidity. So this means that in this case, we didn't take the entry. And of course, once we are in a new trading range, we said that POI available on our previous trading range is now invalid. All right, so I've noted on that, and we are currently in a new trading range, and this one here is the high of that range. This one here is now a break of structure to the downside, and this is the right moment, or this is the moment to mark the inducement, of course. So right here, if I am to mark the inducement, this one here is what we call the minor inducement. I mean this one, let me just mark it. So this one is the minor inducement, and this one here is our swing point high. So yeah, our swing point high. I think I will use these highlighters. I think these highlighters are good to identify these swing points. Anyway, this one is our minor inducement. So let's see if price marks or creates another inducement. All right, price is heading towards our minor inducement. Hopefully, all right. So price, all right, price is actually consolidating at the moment, and I want a clear break past high. All right, so this means that our minor inducement has shifted here. We said that we don't confirm a break of structure, nor we don't confirm a valid swing point without a taking out of an inducement. I said the inducement does not matter, bearish or bullish, it does not matter. So this one here, notice that this is not a break of structure. I mean, what I'm marking is not a valid break of structure because the inducement is not taken out. So the valid break of structure here is this one here. This is the valid break of structure. This is just a break, and this one here is the high of the pullback. And since this whole pullback is the recent one, then this high of this buy side liquidity is what we call the major inducement. Why major inducement? Because it occurred after the break of structure. So let me continue running price. Right, exactly, price here created another inducement. I mean, created another recently formed valid pullback, and the buy side liquidity resting above there. That's what we call the major inducement. So right now I'll be waiting for the major inducement to be taken out before I start marking, or before I start telling myself marking the POIs. All right, so all right, price created another valid pullback, and I said we keep on shifting to the recent one until price takes out or takes it out. So I'll continue running price, and right, I can clearly see that this here is also a break. So this means that our minor or non-minor, I mean major inducement, is actually there. All right, this is the high there. That's the high. So if price takes that high, then of course our inducement is taken out, and we can now start marking the POIs. Exactly right there. And by the way, this is a sweep. We can clearly see that that's a sweep, and this one is of course a confirmed swing point low, and I said I'll be using the highlighter to mark that, and this is the moment to mark the POIs, but I said we don't mark the POIs until we see like price has like displaced from the major inducement, or displaced from the inducement with a significant body size showcasing that that's not a sweep. If you clearly remember, of which I want to believe that you know that the inducement, once the inducement is swept, that's a valid entry module, and price may or may not achieve towards the external liquidity. Right here we can clearly see that price wicked above and made this ultimate you can see this ultimate move to the downside, not an ultimate but actually a possible strong movement to the downside. You can see price wicked and it gave us this momentum candle towards our favor, saying that price is actually heading towards the external liquidity. In this case, if I was to take the entry, you can clearly see, of course, I'll be taking it on the end or on the closure of this momentum candle. Of course, stop loss, I'll be setting it above there, and of course targeting this external liquidity. In this case, you can see my risk to reward will be very small, and I said of course you can do that, but if we check the distance that I'm actually increasing it, you can see this distance is very huge for me to risk such a for me to risk in this trade. So I'll just, so let's actually, if you take the lower time frame execution, you might get a significant or a reasonable risk to reward. But for a direct entry, you can see what price has done. And so in this case, I wouldn't take that entry, and I'll just wait and see if price will violate this inducement sweep, or price may end up breaking the structure. If price breaks the structure, then that will be a confirmed, of course, break of structure. So let's see. Right, I'm seeing signs of price. All right, we said that this, of course, there is a sweep, and we said that once price sweeps, we always mark a line at above here, and we need to make sure that that line is protected, meaning if price breaks past that line, doesn't matter with a wick or a break by body closure, the sweep is violated. And we can clearly see price broke past that high with a big, huge bullish candle or big momentum candle, signifying that the inducement sweep failed. And in this case, now that's the right moment, or the perfect moment, or the moment where we should now be looking forward to mark the POIs. And we said the POIs, we always start with the order flows, because the order flows are primary and the order blocks are secondary. Right, and I said also when marking the order flows, we start on the trading range high, or the trading range high, because this here is actually a bearish scenario, but I should say we are starting from the extreme of the trading range. So this one here is not a valid pullback, and if I was to mark the so this one here will be now the order flow, and we can clearly see it's already mitigated with that move. So the next order flow, of course, will be starting from this, and we can clearly see it's also mitigated. The next order flow, of course, will start from here all the way to this high. And is this order flow mitigated? Exactly, no, that order flow is not mitigated. And down here I cannot see any other unmitigated order flow, because this one here was mitigated exactly right there. We can clearly see this valid pullback mitigated the order flow, and again this order flow was also mitigated by this pullback that created the inducement right here. So this means this one is our extreme order flow, and we said that we don't ignore engineering liquidity where it's present. So our engineering liquidity, of course, in this case, it's this one here. Luckily, in this case, price just displaced above the engineering liquidity with a significant body size. So this means that we have failed two entry modules, that is the inducement sweep and the of course there was no any signs of a sweep from this engineering liquidity, and in this case I don't see any decisional POI, so I'm only left with the extreme order flow. And so not until the extreme order flow fails, I cannot go on to the secondary option, which of course we know the secondary option is of course the POI, I mean the order blocks. So let me continue running price, and of course price created this what we called the long wick rejection candle, and I said we don't take immediately after price has showcased that. We need to see a candle that supports our momentum, or we need to see that price has given that clear rejection with a good candle onto our favor, or heading onto our favor before we take the entry. And this case, that candle, you can see price didn't do that, and right now I will only be waiting for price to create such a reversal pattern. Right, so let's see. Right, price has created that, and right now we can see that this is a decisional, I mean indecisional candle or a doji candle, and right now I'm seeing signs of what we call the evening star. And if you do remember, I said to confirm an evening star we need to make sure that price has closed at least the 50% of this bullish candle that is the one that of course will now be creating the evening star. We need to see a closure past that. So if price closes past that, that's when now we take the entry. So let's see, and exactly you can see price did that. So exactly right there, in fact yeah, of course price was there, so price closed exactly right there. So stop loss above there and target profit the external liquidity. And yeah, the risk to reward in this case is kind of all right. I'm extending it largely, but it's not recommended. So in this case I'll just recommend you to reduce the stop loss and make this, yeah, so that you can see the risk. A reasonable risk to reward in my case is something that is more than 1:2. That's a reasonable risk to reward. So that's the reason as to why I'm always like looking forward for 1:2 if that's the risk to reward that it's the like price is giving. So right here you can see I have narrowed my stop loss, but the stop loss is exactly at the high of this reversal pattern. And yeah, stop loss, you can see the target profit well set. And now let me run the price. All right, and let me make it fast. And as you can see, price is actually heading onto our favor. And finally, I hope price will eventually make it out to the external liquidity. So let's see, exactly right there, price made it out to the external liquidity. So you can see the major drawback of these reversal patterns. The first is that it actually depends, but most of the times your risk to reward will not be that high. You will not be spotting risk to reward. I mean those insane risk to rewards of 1:5, 1:7, 1:6. Your risk to reward, let's say the highest risk to reward that you may spot is a 1:4. Rarely will you spot a 1:5 or 1:6, rarely. But more often you'll be spotting 1:3, 1:2 point something, and all of that. So just be aware of that, and just know that that's how it will be for the direct entries. So yeah, and of course after price has done that, then you obviously go on to our next trading range. Of course we all know that that will be the trading range high, and probably why am I using this? I need to be using this highlighter, but anyway, that's not the most important thing. The most important thing is we understanding what we are doing. And exactly right here, price has made that break of structure, and our minor inducement is, as price broke past this all right now, so this means that this here is our minor inducement. Why minor? Because you can clearly see that this case here price didn't like, you can see that's the low, and this candle, this dragonfly doji, didn't broke past this low. So this means that that maintains the recently formed valid pullback to be this one here. Alright, so let me continue running price. We see if price creates another valid pullback here, and exactly right there price did that. So we shift that to the recently one, and we said that if it's formed after the break of structure, it's called a major inducement. And we said also the major inducement is more impactful compared to the minor inducement. Trades that involve the major inducement tend to work good or tend to have a good win rate compared to the ones that involve the minor inducement. All right, so let me continue running price and see if price creates another pullback or price. All right, exactly, price creates another pullback. So I'll continue shifting until price creates of course until price takes out the inducement. Right, so right here, right, let's see what price does. Exactly right there. Price has, you can see this is a sweep of the major inducement, and once that happens, this is already a confirmed swing point. So a break past that is already what we say a break of structure, and of course this one here is our swing point low. And now we have our full trading range, knowing that it's ranging from that trading range high all the way to this trading range low. This one here is a sweep, and we said that we don't just take it randomly. We need to see a momentum candle before we actually take that sweep. I mean that entry. So let me run price. Of course, I will need to reduce this. All right, you can see price eventually made that and this other bullish candle, so breaking past our major inducement with some huge displacement. And yeah, so that's the reason as to I'm saying like this long rejection by itself, it does not say anything, because we need to see a momentum candle onto our favor before we can actually get into the trade. If I just took the entry upon seeing this rejection and just place my stop loss, of course, above there and target this low, you can see I would end up being stopped out, and yeah, it wouldn't be worth it to be called a valid loss, because that was a, let me call it an invalid loss. So price has taken out our major inducement, and we say that's the perfect moment or the right moment to mark the POIs. And we said we start with the order flows when marking the POIs. And yeah, so right here we can clearly see that this one here is the order flow, the extreme order flow, of course. And coming down, I can clearly see another one here. Yeah, because there is no any other valid pullback except this one, which is already mitigated. So after that, I can see this one, all of this move. If I was to refine this, I would have refined it to this, of which it will be mitigated, and take this one here. But for that case, that now will be some confusion, like it will lead to some confusion. That's the reason as to I'm saying just stick with the whole move. I mean the whole buying move. Yeah, it's always the best idea. So this one here you can clearly see with all naked eyes that is not mitigated, and the next order flow is of course the one that was mitigated by the pullback that confirmed our inducement. Exactly right there. We say that we are not interested with the order flow that comes before the inducement, because it is an automatic SMT. And so in this range, luckily we have two valid POIs or valid order flows. And we can clearly see that this is the extreme and it's unmitigated. So that's what we call the extreme order flow. And the one that is unmitigated and comes immediately after the inducement is taken out is what we call the decisional order flow. There is something that we have missed. It's what we call the engineering liquidity. And the engineering liquidity is the valid pullback, I mean the liquidity resting above, in this case it will be above the valid pullback right before the extreme POI. If you are bullish, it will be below. So right here, the first step is obviously identifying the valid pullback that is right before the extreme POI, and we can clearly see that's the valid pullback that is right before the extreme POI. So that buy side liquidity is what we call the engineering liquidity. We said engineering liquidity should always be marked if it's present on the trading range, because it's a core liquidity just like the inducement, and price may tend to sweep that and make the ultimate reversal without mitigating the extreme POI. Right, so exactly here I am waiting for a mitigation of a POI, and in this case, we all know that the decisional POI mitigation, of course, that's a valid mitigation because that's a second entry module. We said our first entry module is the sweep of the inducement. Our second entry module is the mitigation or a possible reversal from the decisional POI. Our third entry module is the engineering liquidity sweep, and our final and the highest probability one is of course the extreme POI mitigation. Exactly right here, I can clearly see price has wicked inside our zone, and I cannot just take a direct entry, or I cannot just set a sell limit order directly from this zone. Like if I do a sell limit order such that if price just comes and taps this zone, price will automatically trigger, or price will automatically place a trade for me I mean, the broker will automatically place the trade for me. In this case, I wouldn't recommend, because this is the decisional POI, and I say the decisional POI is 50-50. Price may respect the zone or sometimes may disrespect it. And to reduce the chances of price disrespecting the zone, we need to see a possible reversal, a strong possible reversal from the zone. At least that will give us the confidence to participate, and also will reduce the chances of you getting stopped out like more often. So let me continue running price until I see a good reversal, and exactly right here you can clearly see this momentum candle to the downside, and that's enough for me to take this entry exactly after. All right, let me first make sure that this candle has closed. So before I take the entry, I need to make sure that the candle has closed. So right, so the candle closed exactly right here, and stop loss of course at the high, so that I make sure that I get a good risk reward. You can see the risk reward is actually small. Right, so right here it's a 1 is to 1.4. If I am to extend it for 1 is to 2, you can see where 1 is to 2 will be, somewhere there. Right, the distance is not that far. After all, this is a major inducement, so yeah, it's worth it. But this stop loss needs to be exactly at this high or slightly above this high, so that's the most important thing. This one here needs to be a 1 is to 2. I always recommend a 1 is to 2, like a risk to reward that is 1 is to 2 and above. I always recommend that. So right here, let me continue running price. If price will end up all right, price is heading onto our favor. Let me make it fast. Right, so, and exactly right here you can see this is what I was talking about, that price may, if you extend it, now this is the something that I was talking about. If you extend it, price may, yeah, price may eventually achieve that, but you can see this here is another trade, and in fact another valid trade, because after price has made that break to the downside. All right, if you have your mute on, your mic on, I would recommend you to.
Musafiri, please turn off your mic.
All right, that's great. So right here, I can clearly see that price has mitigated the decisional POI. It has made that. You can see this here. So I was supposed to, you see, after the entry, I was supposed to target the external liquidity. And if I was to do that, you can see the risk to reward is less than 1 is to 2. I'm not saying that's bad risk to reward, but as per me, I usually recommend a risk to reward of 1 is to 2, like something that is at least 1 is to 2. Yeah, because for me that's the risk to reward that I find it like reasonable. And then you can see this says a minor inducement, exactly right there. You can see that's a minor inducement, and this one here, of course, it will now be a trading range high. I mean, this one here will be now our trading range high. So if that's our trading range high, this one here is of course our trading range low after the minor inducement is taken out. So that's the minor inducement. You can see the minor inducement here is taken out. And after the taking out of the minor inducement, we need to mark the extreme order flow. I mean, we need to mark our POI. And we can clearly see that this here is not a sweep. So price broke there with a good displacement, signifying that this is not a sweep but just a liquidity run, and price is heading for a POI mitigation. And in this case, we only have one POI, which is now the extreme POI. And of course, price mitigated the extreme POI right there, and it gave us this price mitigated in, gave us this doji candle. Then after that, this bearish candle, and this bearish candle is of good momentum, so I'll just place my stop loss above there and target profit a 1 is to 2. So you can see, in fact, this one here I can just target this because it gives me a risk to reward of, you can see, 2.5. So you can see I would have missed this trade if I just sticked with extending this, if I had to extend this, because my entry from this area would have been there, my stop loss of course above there, so that I can get a reasonable run, and I would have extended this to 1:2. So 1:2 would be somewhere here, and you can see I will still be waiting for price to achieve this area. And on the other hand, price has already made another trading range, and you can see this is an entry, in fact, of good risk reward than the one that I'm in, and you can see I would have missed that entry. So that, of course, I know this is not a good entry, because not that it's not a good entry, but it's involving a minor inducement, and I said that trades that involving a minor inducement have a less win rate. But you can see that maybe in the other case, or maybe in the future scenarios, it will not be a minor inducement, it will be a major inducement, and in that case you will miss that entry just because you extended from the external liquidity. So you can see the external liquidity is here, and you extended this huge distance, even though it's recommended, if especially if it's involving the major inducement. But yeah, take note of things like this. You may miss some valid entries on such scenarios. And also, if you see like this extension or this distance that you're extending just to make that risk to reward 1:2, if it's that huge, then I would just recommend you to not take that trade and just go on to another pair, or just wait for price to give you another entry. Yeah, so that's something you all need to take a note from. And anyway, we are currently in a new trading range. Of course, this one here will be the high of our new trading range. I will love to delete this, and yeah, so where is the inducement? The inducement is this one. In this case, it's a minor inducement. Trades that involve minor inducement, you all know what they mean. They are less impactful, and of course we said if it's involving the minor inducement, our trading range high is what we call the major inducement. Take note of that. In this case, since it's a bearish scenario, that's the reason as to why the trading range high is what we call the major inducement. I think I would just have said external liquidity, just to combine it with the one of the bullish scenario, because in a bullish scenario it will now be a trading range low. Of course, that's also a external liquidity. So using the external liquidity word keeps or generalizes everything. Right, so let me continue running price, and price is heading. All right, price created another pullback, so I'll be shifting to the next one, the one that price has created recently. And we said we don't tie ourselves marking the POIs not until price takes off the inducement. And of course, I'll continue running price. Price created another inducement exactly right here. Very important. Yeah, this one. Yeah, exactly right there. And not until that inducement is taken out, I cannot start marking the order flows. Exactly right there, you can see this is not a sweep, but it is a liquidity run. So this means that I will be now marking the POIs, or this is the right moment to mark the POIs. Yeah, so starting from the extreme, this one here is what we call the major, I mean, the order flow, the extreme order flow, and we can clearly see it's already mitigated by this move, and also this order flow. It's also mitigated by this pullback that created our major inducement. So this means our trading range lacks order flows, or the primary option in this case does not apply, and we will need to now shift to the secondary option, which is of course the order blocks. So now you can see where the order blocks come in play. All right, so let me delete this, and right now obviously I will be starting from the extreme of our trading range. And yeah, let me delete this, or yeah, let me just reduce the size of this line, yeah, so that we can see the extreme clearly. And I can clearly see that this candle, of course, it has taken out the liquidity of the previous one, but it is not associated with a fair value gap. Coming on this next one, it's not associated. Then our trading, this candle high is taken out. So this here is the candle that is associated with the fair value gap, and it has also taken the liquidity, or it has just taken out the previous candle high. It is also associated with the fair value gap, and down below here I don't see any other candle that is meeting the criteria of being called an order block. And also this is the engineering liquidity, because this one is our extreme order block. All right, so let me run price and see what price eventually does. So let me reduce the speed, and let's see. All right, so price has mitigated our zone, and we said that we need to make sure that price rejects with a good reversal pattern. Exactly right there, we can see that's what we call the indecision candle, and right now I am seeing some pattern here, what we call the evening star pattern, and I'll be waiting for this candle to close 50%, of which it has already done that. But first we need to make sure that the candle closes before we actually react. So let's see. Yeah, exactly right there, the candle has closed below the 50% of that bullish candle. So I'll just be, yeah, you can place your stop loss above there if this external liquidity meets the criteria of a 1:2. But you can see this is a 1.3, so I just need to narrow my stop loss to that high, and if I am to extend it, then I will have to extend it because it's not making out the 1:2. But if you would want a 1:1.5, then why not? You can take that trade. A 1:1.5 is also a good risk to reward, but for me I wouldn't have taken that trade. Yeah, I am only, like, I'm strictly uh, wanting trades that are involving a 1:2 and above. Yeah, mean for the risk to reward and stuff. So right now I think my TP will be somewhere there, and this is an extension of quite a good distance from this external liquidity, of which is something that I have explained it here. It may lead to some things like that, and maybe sometimes price may make it out of the external liquidity and reverse all the way, taking you out from the stop loss. So price making out the change of character. So you can see price has made it out of the external liquidity. Probably if you had set your take profit on the external liquidity, in that case you would have secured your you have secured your profit, but just because you extended so that you can get that reasonable risk reward, you ended up missing on that trade, and that trade turned to be a loser. So things like that do happen. So these are things that you need to accept if you are trying to do something like this extension after or extension above the external liquidity. Anyway, let's see what price does. I need to make sure that this one here changes to be the 4-hour, and yeah, maybe 3. Exactly right there, you can see what price is doing. Price has stops us out exactly right there, and price is heading above here. So you can see price has stops us out. So this is a scenario that also happens, and after this, then you can clearly see it's either this. You can see this is what we call the rejection block. This one here is what we call the rejection block, and also we need to check for what we call the hidden POIs. So you can get into the 1 hour, we see if we can spot any hidden POI in our case, and I don't see any, not unless this week, of which price has already. So in this case I'll just wait for mitigation of this rejection block. If not so, then I wouldn't, like, I would just wait and see what price does. So it's either price to mitigate this rejection block or price to do something else, just to see what price does. And exactly right here, price has mitigated the rejection block. So right now I want price to reject from that zone with a good risk to reward. I mean, not a good risk to reward, but a good reversal pattern. So exactly right here, you can see price rejected with a very, like, a very big momentum candle, and in this case this is it will cause, now it will like violate everything, because it will lead to a risk to reward that is very, very you can see the stop loss very big. So in this case the risk to reward is you can see I will have to extend to so that I can make that 1:2. Anyway, I will have to, because if you want to take the entry, then you will have to do that. But yeah, so let's see what price does eventually after that. So anyway, so you can see if you had all right, exactly, price ended up stopping you out, and yeah, so in that case you'll just need to accept that, and yeah, accept that. That's a change of character, and now you have changed bias from being bearish to now bullish. So things like that do happen. It will not always that you'll just be getting wins and wins and wins. Yeah, price may go against you. And what matters is not the individual trade. If you got a loss or a win, what matters is if you had made, like, if you have made profit over the long run. Of course, your winners will engulf the losers, and that's where the play of the risk to reward comes in. If you take more wins than the losses, even if you have a small risk to reward, of course you may end up profiting over the long run. But if you have like less wins than the losses, then in that case, if you have a low risk to reward, then you may end up uh, not profiting over the long run. So that's where now the risk to reward of me saying that you should at least be aiming for something that is at least 1:2. At least that will keep you will keep you, if you get some, let's say the number of losses and wins are equal, in that case you'll still be profitable over the long run, as long as you are risking the same risk percent. If you're risking a consistent risk per trade, then that obviously will make you profitable over the long run. Even if you have less wins than the losses and you have good risk to reward, then that will make you profitable over the long run. So actually, you have seen what I was actually doing, like the showcasing of these trades. This was just a freestyle combining that. The reversal patterns and the mitigation of our zones. And what I want you to note is that this here is happening on the same time frame. So this means that you can actually become profitable with one time frame, and yeah, with only one time frame you can just become profitable with one time frame, and just taking the direct entries just like I've guessed here. But of course, if you want to explore more, get more knowledge on the top-down analysis, of which I recommend, then yeah, you should still learn, and probably you may, yeah, just check both of them, the trading of the same time frame and the combination of top-down analysis too, and see which one works for you, which one seems simple to you, which one resonates with you, and yeah, stick with that. But as far as we have covered right now, I can confidently say that you can just pick one time frame and a set of pairs and just backtest, and probably you will see some results from them. And yeah,